Good afternoon, everyone, and welcome to the webinar for the launch of the IPO for PCX, the Pengana Global Private Credit Trust, soon to be listed on the ASX. I'm Russell Pillemer, CEO of the Pengana Capital Group, and joining me this morning is Nehemiah Richardson, CEO of Pengana Credit, and Scott Wilkinson, Mercer's Head of Private Debt for APAC. Offering Pengana investors a listed vehicle that provides exposure to global private credit is a natural extension for our business, where we already run PE1, Australia's only listed global private equity trust. Global private credit, or GPC, was once upon a time considered to be an alternative or fringe asset class that warranted only small allocations in portfolio construction. However, today, at the high end of the institutional market around the world, this has changed, with GPC now being considered to be a mainstream asset class that commands significant allocations. The key reason for this monumental change in portfolio construction is the compelling risk-adjusted returns generated by this asset class relative to traditional asset classes. The experience of those investors who invest in this asset class shows that including GPC enables the optimization of portfolios, and portfolios that exclude it will inevitably underperform on a relative basis over time. Unfortunately for direct investors in Australia, it has historically been extremely difficult to invest in this asset class. Fortunately, this will now change with the introduction of PCX, a best-of-breed GPC solution that is easily accessible for all investors, whether investing directly or through platforms or IMAs or SMAs. The formal part of today's session will last about 35 minutes with presentations from Nehemiah and Scott, after which there will be a Q&A session run by Adam Myers, the Head of Distribution for Pengana. The session will end at 1 p.m. On the bottom of your screen, you will see an icon for submitting questions. Please click on this at any time. We will attempt to answer all questions, and if there are any unanswered questions at the end of the session, we will follow up afterwards directly with the participant. I will now hand over to Nehemiah.
Thank you, Russ. I'm excited to present the Pengana Global Private Credit Trust, ASX ticker PCX. It's going to provide Australian investors with the best global private credit has to offer. In my presentation today, I'll take you through the offer highlights and details, and Scott Wilkinson from Mercer will discuss Mercer's expertise in portfolio construction and management of private credit portfolios. So if we can just please go to the highlights slide. So in summary, we've partnered with Mercer to bring Australian investors access to very high quality global private credit portfolio that's best in class. It's extremely difficult to replicate, and we've taken 2 years to develop this product to bring it to market. What PCX is going to offer is a very highly diversified multi-manager, multi-strategy global private credit portfolio constructed by Mercer. It seeks to minimize investment risk, which means no single manager, strategy, geographic, or currency risk, given it's fully hedged. The portfolio is already established, having 19 managers with over 2,000 underlying loans. And this is possible because it was seeded by funding that we received from Soul Patts, Pengana Capital's largest shareholder. And the benefit of it is it actually allows immediate investment of the IPO proceeds, putting your money to work immediately, which is really nice. It's constructed to deliver attractive total returns with low volatility and a target annualized distribution yield of 7%, which will be paid monthly. And we have an innovative quarterly off-market buyback mechanism, which provides an additional liquidity option for investors, and we believe should significantly reduce the risk of PCX trading at an NTA discount. So just to quickly go through a summary of the important offer dates. We're currently taking bids in our cornerstone offer prior to opening of the general offer to all investors on the 20th of May. The general offer closes on the 6th of June with settlement on the 13th of June and commencement of trading on the 20th of June. So now I'll just walk through how we define global private credit and why it's so attractive to both investors and borrowers. So this slide shows how we define investable global private credit. In summary, it's customized bilateral loans made by private credit managers to mid-market companies in the US and Europe with EBITDA between 50 and 250 million, so companies of substance. We focus on segments of the market where the banks have withdrawn from mid-market lending due to increased regulatory capital requirements. And this has created a large funding gap for companies that cannot access liquid credit markets. So their only option is private credit firms for their lending needs. So as a result of this dynamic, private credit managers are able to secure very strong contractual protections and security packages, information rights to closely monitor performance, and receive an illiquidity premium given that they hold the loans to maturity. So these terms underpin the attractive yield, the stable income, and the capital preservation characteristics of global private credit. Next slide, please. The left side of the slide just shows what I said in a visual form, right? So it shows the structural gap in mid-market lending in the US and Europe. And you'll see where non-bank lenders are 85% of the market and banks are 15%. I'd note that this is in very stark contrast to Australia, where this same universe is flipped around. It's kind of 90% plus of the credit is provided by our banks, and a very small minority of 10% is actually, or less, is provided by local private credit firms. And that's just because the structural dynamic hasn't really come here. Now, institutional investors, as you see on the right, they're very attracted to private credit's low correlation, low volatility, and attractive returns. So they've been filling this gap, and that's what's been driving the growth in AUM. And so when you see on this chart, it's grown over 3 times over the last decade, and this strong demand from institutional investors and this gap is actually expected to grow into the foreseeable future. Next slide, please. With the growth in the market from borrowers looking for lending and investors putting their money into private credit firms, has come a proliferation of strategies to accommodate borrower and investor demand. Now, PCX's portfolio provides exposure to 3 main types of strategies. The first is direct lending, which is about 65% of our portfolio. That's basically bilateral loans to mid-market companies. Then we have structured credit and specialty finance strategies, which is around 25% of our strategies. And these represent asset-backed lending strategies where the counterparty is a mid-market non-bank originator of assets or a company seeking to finance a pool of assets. And then finally, the third type of strategy is credit opportunities, which is about 10% of our portfolio. And here managers invest in dislocated and distressed situations to achieve really nice yields and equity-like returns. So the objective of this diversification in our portfolio is to create something that's all-weather and resilient through economic cycles, and Scott will touch on that later. Next slide, please. Investors are attracted to global private credit for 3 primary reasons. The attractive risk-adjusted returns and that illiquidity premium I mentioned earlier. The portfolio diversification that they get with the low correlation that global private credit has to other asset classes. So it's a really nice portfolio construction tool. And for the resilience, being the low default rates, high recovery rates that you get relative to other fixed income asset classes due to the active management and the strong protections that I spoke about earlier. Next slide, please. So this slide just highlights that relative attractiveness of private credit between traded credit, which you'll see, and liquid credit on the left, and illiquid private credit on the right. And you can just visually, just in the bar, see the relative returns. But I just point out just one thing that's actually important to understand about how we invest in senior direct lending. So you'll see here on the chart on the right, the senior direct lending returns are 9 to 10%. Well, you can actually lever those underlying returns. That's an unlevered return number. PCX invests in levered classes of senior secured direct lending funds. Now, the underlying levered LVRs are typically 50 to 60%, enhancing the returns by 2 to 3%, taking the senior secured direct lending return from 9 to 10%, as you see on the chart, to around 11 to 13% on a levered basis. For our managers, this is a very prudent and measured way to enhance returns. Given the quality of the borrowers, they're all defensive and acyclical or non-cyclical. The managers have widely diversified lending portfolios, and they experience very low net loss rates, which range from 0 to 60 basis points per annum since the GFC. So I think you can see why it's a really prudent and sensible way to enhance your returns relative to that risk, that very low risk profile. Next slide, please. As you can see from this comparative analysis on the slide, and this on the left side is just showing the return volatility trade-off, with volatility being a measure for risk of a number of different asset classes relative to global private credit. Now, it shows that historically, global private credit has delivered superior risk-adjusted returns with low correlations, really nice return against that volatility, which is what makes it such an attractive diversifier for broad investment portfolios. So I hope through what I've just tried to run through quickly, you can all see why mid-market private credit lending is so attractive and in high demand. I'll now hand over to Scott to cover Mercer's capability, portfolio construction methodology, and investment process.
Thank you, Nehemiah, and hello to everyone. On behalf of Mercer, I'm pleased to be able to present today on PCX and private credit more generally. Just up front, there may be terms private credit, private debt. It's used interchangeably. It is the same thing. So I'll be providing a background on Mercer and our alternatives business, but I'd like to briefly start off by framing how we think about private credit in terms of building portfolios over the longer term. We've heard from Nehemiah detail on private credit as an asset class, particularly key attractions. And in this part of the session, we'll address how we align this to meet overall portfolio objectives. At Mercer, we consider private credit to be additive and a core holding within a total portfolio, which is part of our global reference portfolios. And it has validated its place through consistent and higher returns than fixed income alternatives. Private credit is a highly diverse asset class, and the various exposures have very different characteristics, which can offer numerous potential outcomes. While this can be daunting to a certain extent for someone looking to get into the asset class, it's quite exciting and dynamic from our perspective and can lead to a high degree of customization. This creates enormous opportunities for us as a business. Nehemiah spoke about the various sources of return, but to generate consistent outperformance through the investment cycle, primary active management through a bottom-up approach, but overlaid with a top-down lens, as illustrated on this slide, here becomes incredibly important. But it's complicated because private credit, by definition, is illiquid, and portfolio adjustments can really only happen over a longer period of time, say, compared to public markets. So it requires very deliberate strategic planning and allocation to really maximize consistency through the cycle whilst minimizing idiosyncratic or asset class or asset specific risks. Taking a couple of examples here, you see private debt here is a mainstay in portfolios, being at the top of the capital structure and driven by contractual returns. Whereas in economic declines, more opportunistic or stress-orientated strategies can perform well. Likewise, in junior debt, this can be more conducive in a recovery or expansion phase. This is really an important consideration and a key design feature of constructing and implementing the PCX portfolio to ensure it's anchored with the core senior lending, but also has the ability to take advantage of opportunities as and when they become more conducive in the market. So why are we well placed to provide the solution. Nehemiah briefly touched on the size and scale of Mercer. And really what that means is we have unparalleled access to managers and strategies globally. Everybody wants to be rated by Mercer, and as a result, we see so much of the market enabled to develop unique insights and aggregate a lot of the information that we receive on all forms and various parts of the sub-strategies within any asset class, but specifically here on private credit. And through that scale, we also have that buying power, which means we can negotiate better deals for our clients in terms of both governance or information rights, in addition to the economics or fees associated with an investment. Within Mercer, there's the wealth or investments business, and within that is alternatives, and which is us, an asset management division, investing globally across private equity, private credit, infrastructure, real estate, and a few other adjacent capabilities, impact investing, natural resources, secondaries, co-investments. But with our 200 plus professionals, we advise on over 180 billion US dollars, and also have more than 30 billion US dollars of assets under management through our discretionary accounts. Here we drill down into private credit on this slide. On the left-hand side shows the specific AUA or AUM amounts for private credit. And our approach here is really providing clients with flexible and tailored multi-manager solutions. While private credit may come across as quite new in the investment world, as mentioned before, we have been active in this space for more than 2 decades. But this also includes, importantly, a dozen years or so managing private credit portfolios directly. Understanding the client's objective up front is at the heart of what we do. And we have a global dedicated private credit team focused primarily on 2 core functions. The first is sourcing, diligence, and underwriting funds that we rate, with the aim of including those that we consider to be high quality offerings in our portfolios. The second function is constructing and managing those portfolios. We typically screen 300 to 400 opportunities per annum, and through our discretionary accounts, make about 20 investments. So there's a high degree of selectivity in the market. Also, as we mentioned before, when we invest, it's at significant scale. So again, often getting a seat at the table, negotiating strong fee discounts, etc. So private markets is quite relationship driven. So it's really critical to have on the ground presence in our core regions to drive that investment activity. That clearly helps map out the investment landscape. And with so many managers in the world, originating investments can come from a wide variety of sources. So, we need to really be focused on collecting that information and funneling that through. In private credit, our objective as a team is to deliver attractive risk-adjusted returns that enhance overall portfolio characteristics. Our philosophy here is underpinned by 3 main beliefs. The first being, and Nehemiah mentioned it before, diversification. That's obviously very key, but that's at the manager, strategy, fund, asset level. So it's multi-layered. And when we invest our portfolios, this typically includes a core direct lending exposure at the top of the capital structure to provide that stability in the portfolio. Then we often build around that core holding. The second belief is our fundamental approach of bottom-up manager selection, and I'll touch on that in a moment. The focus really is on well thought out and structured investments with the resiliency through cycles and high contractual returns. In addition, there's a focus on fees and capital efficiency to really drive those returns for our clients. Finally, it's being macro aware and position our investments with managers where possible to invest or tilt into opportunities where there is strong relative value. And we touched on that earlier on the slide. And we apply our philosophy by selectively investing into 5 broad subcategories, and we can see that on the bottom right-hand corner of the slide: direct lending, structured credit, specialty finance, real asset lending, and credit opportunities. The overarching theme to this is to be disciplined and preserve capital. So the takeaway, not losing capital in private credit is paramount. So drilling down more into that manager selection process, it is a critical part of what we do. And if one looks at benchmarking stats, the dispersion between the best and worst managers can be meaningful. So we are focused on what we consider that can outperform and try and avoid those that may underperform. To do so, we have a systematic and proven investment process here at Mercer, during which strategies and managers are scrutinised at each level, with only the highest quality offerings progressing through to the next stage of analysis. Following the sourcing and prioritisation stages at the top of the funnel here, we undertake in-depth due diligence on a quantitative and qualitative basis under our four-factor framework, which I'll come to in a moment. This can ultimately lead to Mercer rating a fund, and specifically for PCX, we are including those that come out with a strong or investable rating. Just to note, we also consider with a separate ESG score as it relates to certain practices and integration that a manager has within their platform. Any fund to be rated will go through Mercer's Global Private Debt Ratings Review Committee, which comprises 7 members. And once that fund is rated and is looking to go into a portfolio, we have a separate governance function through our Global Private Debt Investment Committee to make the investments in our accounts. For PCX, this is further complemented by the Pengana Investment Committee, which is jointly held by Pengana and Mercer. So drilling further down into the manager selection process, I mentioned the four-factor framework, and this is how we assess managers, being business management, alignment, strategy, and track record. This framework is consistently applied across private market asset classes, but obviously nuanced specific to each individual asset class as for their features. So business management focuses on 2 key elements. One is governance, so the heritage of the firm, leadership, the structure and the committees, and the people, the size of the team, the quality, has there been any turnover? Alignment on one hand focuses on the culture and the incentivization of that team as it meets the objective, as the fund is guiding to meet its objective, but also the fund features themselves. Are they GP or are they manager or investor friendly, such as the fee level, identifying key persons, redemption mechanisms for open-ended funds, and so forth. Strategy looks at the execution part of it, the sourcing capabilities, the underwriting, and overall investment process. And then there's the discipline side of strategy. So are they able to consistently invest in that market? Do they have robust portfolio construction capabilities? Basically determining if the manager is appropriately addressing the market, and do they have a competitive advantage? And the final point here is track record. So effectively experience and proven ability to generate performance and exit investments. So we analyze the performance. What are the loss rates? How have they benchmarked, given their level of risk? How volatile has the performance be? These are all elements that we consider as part of our process. So each factor is determined on a 5-point scale, which provides evidence of supporting the overall assigned rating. Now I'll hand back to Nehemiah.
Now I'll just quickly talk through some of the offer details. Next slide, please. So at listing, PCX is going to be 90% committed and over 85% deployed, with this highly diversified portfolio across return drivers, strategies, geographies, and seniority, as you see in the bottom of the slide, with 19 managers and over 2,000 individual loans. Next slide, please. So there's 2 sources of liquidity for investors. Obviously, one is trading on the ASX. The other is our innovative quarterly off-market buyback mechanism, which actually provides you with the option of quarterly liquidity at the NAV to minimize the potential for PCX to trade at a discount to its net asset value. Next slide, please. Now, with regard to the terms of the offer, I just point out a few things. So our objective here is to generate strong risk-adjusted returns with a high degree of capital protection. We want to be delivering stable and consistent income through our target annual distribution yield of 7%, which is going to be paid monthly out of that total return. The portfolio is fully hedged back to $8, so there's no currency risk. The management fee is 1.25%, which we share with Mercer. And we have a performance fee of 20% above a hurdle rate of RBA plus 6, and RBA plus 6 today is 10.35%. Next slide, please. So in closing, just wanted to say we're really excited about this, this product that we're offering to investors. We're offering a unique opportunity to access global private credit through a very high quality and diversified portfolio that's been constructed and managed by Mercer to deliver these attractive total returns, stable income, and capital preservation. We're targeting to pay the 7% annual distribution yield on the monthly basis from the total portfolio returns. And we provide the opportunity for investors to realize liquidity either through trading on the market or through our innovative quarterly buyback mechanism at the NAV. So I'll now hand over to Adam Myers, who will manage the Q&A process.
Hello, everyone, and thanks to our presenters. That felt very comprehensive to me, but we do have quite a few questions, so I'm going to get straight into them. Russ, this feels like a good one for you. We haven't seen a new LIT or LIC, that's a listed investment trust or a listed investment company, come to market for some time. In fact, we have actually seen a few announced plans to delist. Pengana has done something really innovative with the off-market buyback, but why is listed advantageous?
So with the global private credit, this is a particularly good structure to implement. And the reason for that is that it's a illiquid asset class. So with illiquid asset classes, if you don't have a listed structure, it's really quite cumbersome to try and get in and out of these assets. So by having a listed vehicle, investors can get in and out. They can have the liquidity via selling the units on market or buying units on market to rebalance their portfolios. So it's very useful from that perspective. I agree, we haven't seen a lot of positive activity in the listed space for vehicles over the last couple of years. And I think we're probably going through a bit of a cyclical period where a lot of the vehicles are trading at discounts. We have seen this from time to time, and I think we're at the more at the bottom end of that market at the moment. I think that market, by the way, will improve over time as the cycle changes. But irrespective, this is a good structure for a illiquid asset class. And as Nehemiah took us through earlier on, the discount, the mechanism to ensure that we don't trade at a discount to NAV, I think that sort of solves the key issue that investors are worried about. So I think this is an ideal structure to bring to the market at this point in time.
Thank you. Scott, I'm now going to bring you in. 5 years ago, hardly anyone spoke about private credit, but today we're hearing about it all the time. What are the concerns about such rapid growth? Are we going to see yields compress? Is there more competition for deals? What are the risks that we should be thinking about?
Yes, thank you, Adam. I think that's certainly true in Australia. It's been around, 5 years ago, not really heard that often. But in the US and Europe, private credit is actually quite well established. The US is, in terms of lending, has transitioned materially away from banks decades ago, and Europe really followed suit in the wake of the global financial crisis. And the opportunity itself has significantly expanded over this time. And these private credit managers have professionals and people who have come from that banking world and really found new ways and innovative strategies to really penetrate the market. Also, in terms of that growth, when I think about it, private equity continues to grow, and the level of uninvested capital that needs to be invested is quite a large amount. And why that's important is private equity is a strong supplier of deal flow for private credit managers, particularly in the corporate direct lending space. So with a lot of these, there's regulatory changes and structural visibility on the growth of the market. We don't see that really reversing anytime soon. In fact, we're seeing that further continue to grow for private credit and really become that trusted source of capital. And we've seen that over the last few years in terms of banks and public markets, effectively pulling back quite a bit. So it's really solidified, I think, private credit in that space. Of course, there's always risks, and through our multifaceted due diligence process, we're aimed at evaluating and trying to mitigate those risks. But in terms of return compression, we haven't seen a huge amount of evidence showing that. It's been very consistent and really been held up quite strong, even in more benign times, as well as more challenging times. So we think that will persist.
Okay, so risks exist, but more than adequately compensated.
That's right, yep.
Great. The next question is probably also a good one for you. 19 managers, 2,000 underlying loans. Does that not count as over-diversification?
Yeah, I think that's a very good question. And, our objective is to really create a well-rounded portfolio that has the ability to capture returns, over and above public markets. And what we've spoken about through this presentation has been different impacts of economic cycles, different strategies. It's a highly diverse asset class. But, our focus is really on focusing on downside risk, and in particular, mitigating idiosyncratic and deal-specific risk. So that diversification is that real strong lever to pull to try and reduce that. A portfolio with thousands of underlying loans exposed to all the same risks in the same part of the market, it's not really that well diversified. So we're obviously very careful to avoid that trap. But when you look at the portfolio that we're creating for PCX, it's targeting specific areas and including managers where they're not playing in the same space. So we're trying to exploit different niches, and thereby different return drivers that can be sustained through a cycle. And Nehemiah touched on it before, the largest portion of this is income managers. So being at the top of the capital structure in direct lending, where there's a huge amount of underlying assets. Returns are contractual and often capped. So in order to ensure that there's consistency of returns, if there is a potential issue in a portfolio, it's not going to have a material impact on the overall returns.
Diversification is the only free lunch. Okay, next question, which again feels like it's most appropriate to direct to you, Scott, is you spoke about the variation in returns between the top and the bottom performing managers. What are the bottom guys doing wrong, and conversely, what are the top performers doing right? And the second part of that question is, how easy is it to identify which managers are going to be in which segments in advance?
Yep. Yeah. No, that's another good question, and we see there can be a dispersion of returns from the top and the bottom managers, and it can depend on what particular area of the market that they play, and also overlaying the market environment that we're in. And for example, in more benign times, in the 2010s, you would often see, given lower default rates and fairly stable pricing, you saw a much greater consistency of return. But when there's more interesting opportunities that come through in different market environments, then you can see higher returns, but also managers need to be able to execute that and generate returns, and that can often lead to more losses in a portfolio. So what we're trying to do is, as part of our process, is to really pick through that and get comfortable around their managers' skill and ability to work through that and really, and I mentioned that before as the overarching theme, by not losing capital, you'll win in private credit. That's what really drives the investment return. investment returns are largely capped to the upside. So mitigating or getting comfortable around the ability to not lose capital is really critical.
That makes sense. I like that. Winning by not losing. Nehemiah, question here about how little exposure there is to Asia and the rest of the world. Is that surprising? Is that by design? Well, it's obviously by design, but can you expand on that a little?
Yeah. So look, I don't find it surprising, and the reason is I just don't think those markets are yet as attractive as the U.S. and Europe. Firstly, because you don't have that growing supply-demand gap that you see in the U.S. Secondly, Asia is a bunch of individual market structures. It's not, a homogeneous sort of, single place to invest. And so, there's many countries there that don't have proven legal frameworks that allow managers to exercise their creditor rights. And in credit, you need to be able to do that to recover in the event of default. And where frameworks do exist, the banks dominate the lending landscape like they do here in Australia. And so there isn't this sort of illiquidity premium and some of the defensive characteristics that you see that are prevalent in the US and Europe in those markets. And I think that's why you don't see a lot of exposure into those markets, where we sit today.
We have disclosed a target yield in our prospectus, our PDS, but no return objective. Would you just explain why we have done it?
Yes. Well, ASIC discourages new strategies from disclosing performance objectives. However, I'll note two things. Firstly, you can look, and in the slide I talked about earlier that showed the direct lending returns and how strong they've been, and how they can be enhanced, as I spoke about earlier. That's one point. And the second point is that our performance hurdle is RBA plus 6, which is today, 10.35%. And of course, we hope to be earning a performance fee. So I guess I'll leave it at that, Adam. Thank you.
You touched on the quarterly buyback mechanism, but you didn't go into too much detail. Can you just provide a little bit more information, reasons why, and process involved, etc.?
Yep, sure, no problem, Adam. So the way the on-market buyback mechanism works, or actually I'll step back. The reason that's in place is because historically you've seen that LITs can trade at a discount, and we were very concerned in putting the product out, to market, given the defensive characteristics that we're actually trying to provide for investors. If the underlying is providing that, but the listing doesn't, it's disappointing for everybody. So we put in place a mechanism that allows for effectively an off-market buyback every quarter for up to 5% of all of the issued units of the trust. Okay, and so the process would then be every quarter, we will put out an explanatory memorandum that provides an offer to tender shares into a buyback before the end of a quarter. We will then have a closing date where everyone has an opportunity to kind of tender their shares if they want to exit at the NAV. To the extent that it's below 5%, all of those offers will be accepted. To the extent that it's over 5%, it'll be pro rata for all the units. And then what will happen is, in effect, it'll be like a sale, because those shares will be locked up. And a quarter, 3 months, and 10 days later, we would pay investors the NAV from the previous quarter at that point in time, plus the value of distributions over that 3-month period. So in effect, before the end of a quarter, you can tender your shares into a buyback, and we'll make sure it's pro rata, and then you'll get paid 3 months later at the NAV plus the accumulated distributions over that time.
Great, thank you. We have time, I think, for one last question, and this one is actually mine. And Russ, I'm going to ask it to you. You've been all around the country talking about this offer. Are there, or is there any common question that you have been asked in those meetings that you haven't been asked today that you think would be useful for people to hear the answer to that question?
Yeah, I think we've covered probably everything that we needed to cover today. I think this probably the biggest question that we get asked towards the end of meetings is, okay, how do I put this into my portfolio? What do I need to sell something? You know, where does it fit in best? I think most of our advisor clients are putting it into their fixed income parts of their portfolios. It rates really well relative to bonds or hybrids or whatever else they might have in those portfolios. Some are putting it into alternative sleeves of their portfolios, which can make sense, obviously, as well. I think it's an interesting discussion because you know, this has got so many different characteristics, and you can really use it in many different places. A good example of this is investors who are thinking about their portfolio in terms of growth assets and defensive assets. So this could actually be both. So the return profile is obviously a return profile that's commensurate with a return of a growth asset or equities. And yet when you look at the volatility of it and the frequency of income payments, etc., it certainly can be a defensive asset as well. So we've seen investors use it throughout the spectrum, and sometimes they mix and match. So, you know, some investors might put, you know, a portion of it into their growth and a portion of it into their defensive portfolios as well. So I think just, you know, overall a useful asset to have in portfolio construction.
Right. Well, thanks for joining us. If we didn't answer your question, or at least a variant of your question, we'll get back to you directly. And if you have any other questions or you need more information, please get in touch with us. Our contact details for all the different investor segments are available on our website. That's pengana.com. I also urge you to check out our private credit website, which is pengana.com/PCX, where you will find the PDS and additional information around the sector, the offer, etc. We also have a few really good white papers there which explain the investment considerations and good ways to think about portfolio construction and that sort of thing. Our broker syndicate assisting us with this offer are Taylor Collison, Morgans, Shaw and Partners, and Canaccord Genuity. They're also all well placed to help with the products and, of course, with the offer, the opportunity to invest. Just a reminder of the key dates. We are currently collecting cornerstone bids. The offer opens on the 20th of May and closes on the 6th of June. It's not a huge raising, only 250 million. And there is a priority offer which is available for all existing Pengana investors. So please get in touch with us if you need any assistance with that. Thanks again for your attention and enjoy the rest of your day.